This is the second video looking at the roles that are performed by different financial institutions. We've talked already about what commercial banks, building societies, central banks and investment banks and insurance companies are in the last video. And we're just finishing looking at this chart here, which are the different roles that are done by commercial banks and central banks. So for each one you needed to say which entity is it that does that thing. We're on to the final row here. This one manages a country's foreign reserves and can intervene in foreign exchange markets. So a country's foreign reserves, that's where the country is keeping, for example, dollars and, for example, Australian dollars, American dollars, or if they're keeping euros and they're sitting there. Those are kept at the central bank. Also, they can intervene in foreign exchange markets. That means that the central bank can buy and sell currencies, which will effectively affect the value of those currencies. So if they were to buy a lot of pounds, because the demand for pounds would go up, this would mean that the value of the pound would go up. Generally speaking, this isn't done in the UK with our currency. The currency isn't manipulated by the central bank, but it is a possibility. So this one is the central bank. The next one, issuing loans, including overdraft. So remember, an overdraft is when you spend a bit more money than you have in your account. It's like a little loan to individuals and firms on which interest is charged. This is done by commercial banks. If as an individual or a firm you want to get a loan to buy something, or as an individual you might be getting a mortgage to buy a property, or as a firm you might be doing the same to buy a property, you would go to a commercial bank and take out that loan, and then you'd have to pay interest on your loan. The next one, they issue banknotes and they supervise the economy's supply of money. Again, this is a big job. It's done by the central bank. When they issue banknotes, we say that they mint them. That means they're making the banknotes and also the coins. And they can also affect the supply of money. For instance, if they want to increase the supply of money, this would be a type of monetary policy, which is different from changing base rate of interest. They could also increase the supply of money. We call that quantitative easing. That would be done by the central bank. And we've already looked at this, examples of central banks. We said the Bank of England, the Federal Reserve, the European Central Bank, and examples of commercial banks would be HSBC, Santander, for example. Just one last point to talk about building societies. Building societies, like the Nationwide, are very similar to commercial banks, but the big difference is that they were actually established in the first place to take deposits from their members. People who deposit money with them are members, and they actually effectively own the building society. And that money that is deposited with the building society is then lent out, but it's lent out for mortgages only. That was the idea of building societies. So it's a bit like it's being lent for buildings. That's how to remember. And that's what the money is deposited there for, so that it can then be lent to other members who want to take out a mortgage. And as I say, it's owned by the members. They have a say in how it's run. Whereas a commercial bank, for instance, HSBC, that's a public limited company, and HSBC as a public limited company is owned by its shareholders. It's not owned by the people who put their money into the bank as savings. That's the big difference between a commercial bank and a building society.